of the day. Last 30 to 40 years have witnessed increasing interdependence among the world nations. Although nations are physically separated, they seem integrated through cross-border flow of goods, services, people, capital, information and culture. Integration of the capital market has necessitated the unification of financial reporting methods and hence the accounting. Accounting is a language of any business. It helps to identify, measure and communicate accounting information to permit informed judgment and decisions by the users of the information. International Financial Reporting Standards (IFRS) have been developed with the intention of alliance in accounting methods. Through this lecture, we attempt to sum up the developments pertaining to IFRS. The lecture has been divided into 4 phases. The first part discusses the worldwide transition from national accounting standards to international accounting standards. The second part relates to progression in IFRS in an Indian context in the form of Ind AS. The third part discusses the various benefits offered by IFRS. Lastly, summing up the discussion, challenges in the process of convergence have been discussed in the 4th section. Although the first discourse on accounting methods is 500 years old, accounting standards as we know them today are of relatively recent origin. They have largely evolved in a well-developed capital markets of Western countries. They emerged as an aid to a serious agency problem intrinsic to corporates. We all know that in a corporate structure, ownership is separated from the management. The providers of capital gain the status of outsiders to the organization, whereas managers become insiders. Managers have the real controlling power with detailed knowledge of the firm's overall performance. Given this, owners are always apprehensive that managers act in their own self-interest. Thus, they are willing to supply more capital only at a premium to compensate for this information disadvantage. Under such circumstances, to ensure flow of capital at low cost, it is pertinent to keep a check on managers' performance. This can be done through performance reports verified independently by professional auditors. In this context, uniform accounting and auditing standards have evolved. They provide a relatively low-cost solution to the serious agency problem. They help to underpin how capital is allocated, reduce information asymmetry, improve financial reporting quality, and facilitate efficient functioning of capital markets. Over the years, different accounting standards have been developed worldwide. Much of the diversity have resulted from differences in the legal systems, income tax systems, historical, political, and economic ties, size and complexity of business enterprises, development of financial market, sources of investment and financing, the level of community education, predominant culture and language, and the overall economic development. Because of differences in accounting standards, there exist different accounting choices and therefore different financial reports and their quality. However, the ongoing globalization process throughout the world has brought to the forefront the problems engendered by these differences in accounting reports. These differences have made difficult for analysts and investors to participate internationally. They need to understand the integrities of different sets of accounting rules and regulations followed worldwide. Translations and reinstatements of financial statements to meet a nation's norm is an arduous exercise both in terms of money and time. Further, the robustness of different accounting standards and principle has been questioned again and again. Uniformity, rationalization, comparability, transparency, and adaptability in financial statements are very much needed for true cross-border economic and financial integration. It is this quest for international harmonization that has resulted in widely acceptance of International Financial Reporting Standards (IFRS) as useful as well as rational. Long back in 1960s, the debate on international harmonization of accounting standards started. It formally commenced in 1973 with the establishment of the International Accounting Standards Committee, IASC. IASC was assigned with the task of drafting international accounting standards to gain investors' confidence and to provide a strong investment climate. This was a private sector initiative which was founded as well as funded as per an agreement between the accountancy bodies of over 75 countries, including our own, the Institute of Chartered Accountant of India. Between 1973 and 2000, the IASC developed a comprehensive list of accounting standards and interpretations, a conceptual framework, and various other guidance. However, the ascendancy of IASC as the major global standard setter took place from the beginning of 21st century. In 2001, the ISC formally restructured into International Accounting Standard Board (IASB). It was a full-time London-based independent privately funded organization with the objective of formulation and implementation of international accounting standards. All 41 standards issued by the IASC were adopted. Not only adopted, they were also amended and updated according to industry and accounting needs. Hence, thereafter, they were renamed as IFRS, International Financial Reporting Standards. The first major boost to these new standards came with the European Union's decision to adopt them in 2002. EU had 25 nations as its members. With this decision, it became mandatory for all EU registered companies to adopt IFRS by 2005. This brought in nearly 1/3 of the world economy at once under the ambit of IFRS. The EU decision provided momentum toward a single standard throughout the world. IFRS provided the European members with a ready-made, high-quality set of accounting standards, which, by and large, replaced the existing 25 conflicting national accounting standards. Similarly, adoption of IFRS by Australia, New Zealand, Hong Kong, and South Africa provided momentum for their worldwide adoption. They were also supported by many international organizations, including the G20, World Bank, International Monetary Fund, Basel Committee, International Organization of Securities Commissions, and International Federation of Accountants. China started convergence with IFRS in 2006. Russia and Brazil have also adopted IFRS for all companies whose securities are publicly traded. The East Asian countries such as Malaysia since 2012, Korea since 2011, and Singapore is also going for full convergence with IFRS since 2009. Without any suspicion, adoption of IFRS can be said to be a remarkable success story of international convergence. This convergence was never self-evident. Many other movements of corporate governance harmonization have faced resistances. The adoption of IFRS from such a large cohort of countries is a great achievement considering country-specific variations. It becomes even more remarkable as this adoption represents a fundamental change in the conceptual foundation and basic principles of financial accounting. Also, the result exhibited in a private organization, namely IASB, rather than a government one, for formulation and implementation of international accounting standards was beyond imagination. What do you think can be a reason behind this large-scale convergence? It was an idea that a global common accounting standard will integrate and enhance the efficiency of financial markets globally. It will improve financial reporting quality through transparency and accountability, corporate governance and stewardship, informed economic decision making, and thereby maximizing the use of economic resources. Still, the adoption of IFRS and plans for convergence differ widely by jurisdiction. Going by numbers, as per IFRS Foundation report of September 2018, 87% of profile jurisdiction require IFRS standard for most domestically accountable companies. Out of 166 profile jurisdictions, 144 require IFRS standards for all or most companies. 12 jurisdictions permit all or most companies to use IFRS standards. 9 jurisdictions have their own national standards or are moving to IFRS standards, and only one jurisdiction require IFRS standards for financial institutions. 15 of 20 G20 economies require the use of IFRS standard. 86 of 166 profile jurisdiction require or permit the use of the IFRS for small and medium enterprises (SMEs). In terms of GDP, jurisdiction that require the use of IFRS standards is $35 trillion of the total world's $76 trillion. Maybe hard to believe, but 27,000 domestically listed companies on 88 major stock exchanges in the world uses IFRS standards. Some of these jurisdictions have adopted IFRS verbatim, whereas others have made modifications. For example, EU and Canada have adopted IFRS as issued by IASB. Emerging countries like China and India have modified them to meet their domestic conditions such as economic policies, financial regulation, and taxation norms. The remaining major capital markets without an IFRS mandate are the US, with no current plans to change; Japan, where voluntary adoption is permitted but not required; and China, which intends to fully converge but at some undefined future date. In 2002, IASB and Financial Accounting Standard Board FASB, the body supporting US GAAP, announced a program to eliminate differences between IFRS and US GAAP. International Financial Reporting Standards are principle-based set of standards. They establish broad rules rather than dictating specific treatments. As opposed to this, US GAAP is a rule-based approach with more emphasis on the application of standards to specific examples and industries. In August 2008, FASB conceded that US could no longer prescribe American rules for other countries to follow. Thus, it allowed foreign companies access to US capital markets while reporting under IFRS. Until this move, any company wanting to be listed on the New York Stock Exchange or any other US exchange had to engage in a costly reconciliation between its IFRS compliant financial records and the results under GAAP. After all considerations, in 2012, the American authorities finally announced that they will continue with separate US GAAP for the foreseeable future, but sought to encourage further work to align the two. Let us now discuss the position of IFRS in an Indian context. India is a recent participant in the IFRS adoption change. Ministry of Corporate Affairs (MCA) announced its roadmap for adoption of Indian accounting standards from the financial year 2016-17. India has chosen a policy of gradual convergence to IFRS. This has been mainly on account of several generic and specific issues involved in the process. technical, multi-layered legislative and institutional frameworks for accounting, auditing, and banking represents one such problem. The solutions to these issues require timely coordination between various aspects of Indian legislative and institutional framework. Why Indian authorities, you think, chose this path of convergence to IFRS? The answer lies in resource dependency and continuous interaction with the outside world. The process of aligning Indian accounting standards with the rest of the world has gained momentum since 1991. It was a part of an initiative to liberalize the Indian economy and attract foreign participation in technology, business, and investment. When India looked at the outside world, it found USA as the major source of such resources. Thus, India aligned its accounting standard with the US GAAP to meet the precondition of transparency in financial reporting by foreign investors. The result was increased foreign participation in Indian business. It also provided Institute of Chartered Accountants of India with experience and the reputation for bringing such changes in regard to accounting standards, governance, training, and regulatory frameworks. Under its aegis, the Council of the ICAI has so far issued 29 accounting standards. However, AS6 on depreciation accounting has been withdrawn on the revision of AS10 property, plant and equipment. Also, AS8 on accounting for research and development has been withdrawn consequent to the issuance of AS26 on intangible assets. Thus, effectively, there are 27 accounting standards at present. Let us now discuss how India has planned to move from national accounting standards to IFRS. The process started long way back in 2006. ICAI, being the accounting standards setting body in India, initiated the process with a view to enhance acceptability and transparency of the financial information communicated by Indian corporates through their financial statements. This move was subsequently accepted by the Government of India. However, decision was made to converge and not to adopt IFRS issued by the IASB. The decision was taken after the detailed analysis of IFRS requirements and extensive discussions with various stakeholders. It was decided that there will be two separate sets of accounting standards. First, Indian accounting standards converged with the IFRS, that is Ind AS, and second, existing notified accounting standards. Once the decision was made, there were concerns regarding the regulatory framework of Ind AS in India. It was decided that they will be issued by the Central Government of India under the supervision and control of Accounting Standard Board ASB of ICAI and in consultation with National Advisory Committee on Accounting Standards. ASB is a committee under Institute of Chartered Accountants of India, which consists of representatives from government department, academicians, other professional bodies like ICSI, ICAI, representatives from ASSOCHAM, CII, FICCI, etc. National Advisory Committee on Accounting Standards is acting as the accounting advisory body to the central government on formulation and implementation of accounting policy and accounting standards for adoption by companies. It recommends these standards to the Ministry of Corporate Affairs, MCA, who then has to spell out the accounting standards applicable for companies in India. While formulating Ind AS, efforts have always been made to keep these standards in line with the corresponding IFRS. Departures have been made where considered absolutely essential. They have been named and numbered in the same way as the corresponding IFRS. The changes have been made considering various factors. For example, various terminology related changes have been made to make it consistent with the terminology used in the Indian law, like statement of profit and loss in place of statement of profit and loss and other comprehensive income, and balance sheet in place of statement of financial position. Also, certain changes have been made considering the economic environment of the country, which is different as compared to the economic environment presumed to be in existence by IFRS. The differences which are in deviation to the accounting principles stated in IFRS are commonly known as carve-outs. Therefore, a carve-out means that certain requirements of IFRS are not adopted in Ind AS. On the other hand, where there is certain additional note or guidance given in Ind AS which is over and above to what is given in IFRS, it is termed as carve-in. These carve-ins and carve-outs have made Ind AS more suitable to the country. The MCA in India, the nodal ministry for implementation of Ind AS converged with IFRS, announced the roadmap for its implementation starting on 1st April 2011. However, the compliance was not easy and was deferred in view of the pending resolution of several issues regarding taxation, the accounting regulatory framework, banking awareness, training and implementation cost, and similar others. Finally, MCA, via a press release dated 6 January 2015, announced its roadmap for adoption of Ind AS from the financial year 2016-17. Soon after, roadmap for the implementation of Ind AS for banking companies, insurance companies, and non-banking financial companies was also announced via press release on 18 January 2016. As per MCA, the Ind AS was to be implemented in 4 phases. Phase 1, with effect from financial year 2016-17, required all listed and unlisted companies with net worth of rupees 500 crore or more to implement Ind AS. Phase 2, which was effective from financial year 2017-18, covered all the remaining listed companies or companies in the process of listing, and also the unlisted companies with net worth of rupees 250 crore or more. NBFCs and banks were required to implement in the next 2 phases, which are Phase 3 and Phase 4. Phase 3 required all banks, NBFCs and insurance companies whose net worth is rupees 500 crore or more to implement Ind AS from the start of financial year 2018-19. Phase 4 was made applicable to all the listed NBFCs and all the other NBFCs whose net worth is rupees 250 crore or more with effect from 2019-20. However, due to certain reasons like unpreparedness, amendments in certain related laws, high compliance cost and time required, the Reserve Bank of India, through its press release in March 2019, deferred the implementation of Ind AS in banks till further notice. Then, it also was in the news that certain banks have demanded the postponement of the applicability of Ind AS as they did not have a suitable regulatory environment for the implementation and time is too short to make the necessary changes in the processes and the IT systems. They are already in the pressure to improve their financials, and the Ind AS implementation will add to their compliance burden, especially in the area of provisions for the losses in loans. Similarly, the Insurance Regulatory Authority of India has also postponed the implementation to financial year 2020-21 with comparative year being 2019-20. The voluntary adoption of Ind AS by such companies is also not permitted. Pursuant to the above announcement, various steps were taken to facilitate the implementation of Ind AS. Ministry of Corporate Affairs has issued the company's Indian Accounting Standards Rules 2015 wide notification dated February 16, 2015 covering the revised roadmap for companies other than banking companies, insurance companies and NBFCs. The companies on which Ind AS is not applicable shall continue to abide by the rules and standards mentioned in the company's Accounting Standard Rules 2006. A company could voluntarily also follow the Ind AS before it was made mandatory. However, in case a company had started to follow the Ind AS, then it has to abide with it consistently. There is no opting out once implemented voluntarily or mandatorily. Further, they are applicable to all financial statements, whether standalone or consolidated, and for the application of the standards, both calculating net worth and listing of the companies are mandatory. As on date, 40 Ind AS have been made applicable in India. Their implementation and evolution is going on and is committed to make the Indian accounting better and global.